Hello again, everybody, and in this video I'm going to discuss an estate planning legal strategy that could enable your children to pay significantly less income tax. Okay, I'm Paul Rabalais. I'm an estate planning attorney. I help our clients get and keep their legal affairs in order. People come into my office on a regular basis and they're hoping that I can tell them some things that could enable them or their family to pay less tax. Nobody likes to pay tax. It's getting harder for me to come up with strategies to enable people to pay less tax. Assets that people have in their estate, it's hard to get them out of their estate. If people have traditional IRAs, they have to take the required distributions. And now under this new Secure Act, when you leave your traditional IRA to your non-spouse, to your children, they have to take distributions and pay all of that income tax within 10 years after you pass away. No getting around that one either. So it's getting harder now to really come up with some legal strategies to help families pay less tax. But there's one that I want to go over with you that in the right circumstances, and I bet you didn't think of it, if the circumstances apply to you or if they didn't, this strategy can really enable your children to really cut their income tax bill way down for a few years. So let me give an example. Let's call him Dan the dad. Dan has let's call it a $4 million estate, and he's got two kids, and I'll call them Charlie and Charlotte. Doesn't rhyme with charity, but the first part of their names, makes it easy to remember. And Dad's plan is, Charlie and Charlotte are doing well, and Dan's plan, he may or may not be making some charitable gifts during his lifetime, maybe to his church, to his college, but Dan is pretty adamant about wanting to leave 15% of his estate when he dies to one or more charities. He's hearing all this stuff out there about how, the government is encouraging people to support charities, so the government doesn't have to support the charities and do all of that work that the charities otherwise do. Dan hears there's great tax advantages to supporting charities. So, and he just wants to, do something good and leave something behind to help the world, the community be a better place. So he wants to leave 15% of his estate to charity, and he wants to leave the rest, the other 85%, to be divided equally between Charlie and Charlotte. I guess they'll each get 42.5% each. So he could do that, and many people with that intent, that's what they do. And then when Dan dies, there's no estate tax. The $4 million that he has is under the $11.58 million that people can have and completely avoid the 40% estate tax. So when he comes to somebody like me and we set all that up and then he dies, $600,000, let's say when he dies, his estate is exactly $4 million. He left 15% to charity or charities, $600,000 going to the charities, $3.4 million or $1.7 million each to Charlie and Charlotte. Everybody's happy. So the strategy I want to go over with you, if Dan's cool with it and the kids are cool with it, is maybe Dan comes in and tells me, Paul, I want you to set up all my estate documents. I want 15% to go to charity. The rest can go to Charlie and Charlotte equally. And then I might say, well, Dan, just tell me what you think about this. You've asked me a couple of times if there's any way that we can avoid tax, save tax. But what if, Dan, you had an arrangement with your children and we structured your estate legal documents so that you leave your entire estate to your two kids, $4 million when you die, $2 million each, and you and your children have an understanding that they're going to take 15% of their inheritance, $300,000 apiece, and they're going to make a charitable contribution to the charities that you had previously directed them to support. And when those charitable contributions come from your children after you die instead of coming from your estate, your children will get an income tax deduction for making that charitable contribution. And maybe they'll do it all in one year. Maybe they'll do those contributions over a period of years. It just depends on how much of those contributions are deductible, and how the income tax rules apply to those charitable contributions that Charlie and Charlotte would make each year for maybe a few years after you pass away. But quite frankly, if Charlie and Charlotte are in the 40% income tax bracket, by leaving your estate to your kids and then allowing your kids to make charitable contributions that are income tax deductible, then that could save your two children another $240,000 of income tax. So Dan says, when Dan hears that, Dan says, man, I think I like the idea. I know my children are responsible and they do well, and they're going to honor my wishes, whatever I ask them to do. So let's set it up that way. And Dan goes and has a conversation with his kids. And so it's not something everybody would do, because quite frankly, many people, most people don't want to leave part of their estate to their charity. They want to leave as much as they can to their family. So, but for that small percentage who have a decent sized estate, a decent enough where if it's left to the kids and the kids donate a piece of that to charity, the charitable income tax deduction is worthwhile to the children. But I will say, on the other hand, if Dan the dad's estate is more than $4 million and we're here in 2020, that may not be the right strategy to do it that way, because our estate tax exemption, it's $11.58 million, but on January 1st, 2026, it's scheduled to come back to $5 million adjusted for inflation, going to be somewhere around $6 million. So if dad's estate creeps up over that estate tax exclusion amount over the years, and he leaves his estate to his kids, there's going to be estate tax due on the amount over the exclusion amount. However, if he leaves it to charity from his estate, then his estate will get an estate tax charitable deduction, and that charitable bequest won't be included in dad's estate. So right now, that doesn't matter. That's a non-issue. $4 million estate, $11.58 million estate tax exclusion amount. But it could matter in coming years when the estate tax exclusion amount gets cut roughly in half. So that's just something that we'd have to watch out for. So bottom line here, for some families who want to leave part of their estate to charity, but their family would get no tax advantage from that, maybe the better solution is for the parent to leave it all to the kids and let the kids make the charitable donations and get the charitable income tax deductions as a result of it. So anyway, hope that helps. I'd like to hear your comments on that strategy, whether you've ever heard of it before, whether you think it makes sense. Maybe if you want to poke some darts in it, feel free. Also, make sure you slam the subscribe button and the notification bell so you don't miss anything. And then tune in every 10 a.m. Central Time every morning, more estate planning educational videos. And while you're at it, you might as well smash the thumbs up button, Google, YouTube, Google, whatever. YouTube is owned by Google. They like to see you smash the thumbs up button. All right, we will see you tomorrow. Take care.